What's going on? Welcome back. Ryan here. Again, nothing in these videos is investment advice or trading advice or should be construed as such, right? I don't know your situation. I don't know your risk tolerance. I don't know how much money you have. I don't know what your goals are. So there's no way that I can actually give you that trading advice, right? And it's important to understand that this is only for education purposes, right? I'm giving you all of these tools and this insight from my years of experience to give you all of the power that you need to make these high quality decisions yourself. Okay, so in this video, we're talking about the long strangle and the long straddle. Now, again, before we talked about the short strangle and the short straddle, and now we're going to talk about the opposite of these trades where instead of selling options and being short, we're going to buy options, okay? So let's talk about that. Let's talk about the long straddle first. So again, here we have Apple, $176.28. And let's say that I know Apple is either going to make a new high, or it's going to trade lower, but I don't know when, I don't know by how much. These are really common strategies to use coming into earnings or trying to do an earnings play where an underlying asset could have a really large move outside its expected value. And important to, again, just have these tools and understand when and how we can apply them. So if for whatever reason we think it's going to make a large move, but we don't know quite how much, the long straddle would be the opposite of the short straddle, where now we come in here and we buy the same strike, right? So we'd come in here and we would buy one of the 175 call, one of the 175 put, and this would give us a debit of $5.30 times 100 shares, or $530, right? So our max loss is $530, right? So again, when we're buying options, this is a defined risk strategy. You can only lose the premium that you put up for these options. And again, when we look at this and we analyze this trade, it's going to be the opposite of when we sold. So again, if we turn this into a sell, there's our short straddle. Again, if we turn this into a buy, here's our long straddle. Now, where do you lose money on this? Well, you lose money if the underlying asset doesn't go anywhere, right? Remember, on the short straddle, because we sold the options, we do not want this to go anywhere, right? We want it to stay in between our little zone here, where as time goes away, these options erode and we keep that premium, okay? And then on the buy side, right, the long straddle, we're really planning for the underlying asset to make a large directional move in either direction, right? Excuse me. So the long straddle, right, buying these options, buying the call, buying the put, can be really lucrative, right, in the right scenario where the asset makes a large move maybe we weren't prepared for, but we played both sides and we made money no matter what it did, right? So I'll give you another example of this, right? If we look at another asset like Amazon, and we, for instance, if we come into not this particular earnings, but this earnings that happened around what day was this? On 7/29, right? Look at what happened here. Obviously, this thing gapped down huge, right? This is like almost a $300 gap down, right? So if you let's say that you bought some type of straddle the day before this happened, right? Where you came into Amazon, right? And you bought, right? You bought the at the money, you bought the at the money call, you bought the at the money put, right? You spent a credit for it, right? Here's our trade, right? Well, if Amazon from where it is now, just as an example, dropped $300 and ended at 3,100, which is kind of what happened, right? You would have made 22 grand on this trade, right? I love these long straddles. I think that this is a fantastic trading strategy when you don't know what's going to happen, but you know that it's going to make a large up or down move, usually around earnings. And really the way to play this around earnings is actually buying these like 30 days out before earnings. And the reason why is because if you can get into this trade prior to earnings, right? Because we're buying options, when volatility increases, these option prices will increase, right? So most of the time, if you can buy the options if you can buy the option that expires after earnings, very close to earnings, where that particular option expiration contract will be affected by the volatility, right? You could buy these options, and as you approach earnings, they can be, the underlying asset doesn't need to even make a huge move directionally for these options to gain in value just due to the increase in volatility, right? So, and that takes me to the next trade, which is the Long Strangle, right? Which is the trade that I tend to like to put on this Long Strangle as we're coming into earnings, because of exactly what I said, where the increase in volatility can make these options juiced up with value, as well as the potential underlying asset making a large directional move in either direction, which I would then capitalize on, right? So again, if we look at Amazon here and we were to look at what the Long Strangle is, well, the Long Strangle would be buying the put and buying the call above and below the market, right? And buy, and let's change that. So again, we can analyze this trade, and just for an example here, we'll put back the straddle. Right, so again, here is the straddle, right, where it comes to a point because we've purchased the call and the put, right? Long straddle, we're purchasing the call and put at the same strike, anticipating a large move in either direction, as opposed to the short straddle, where we're selling the same call and put, same expiration, same strike, and we don't want it to move, right? And then on the other side of this, again, we have this Long Strangle where it doesn't come to a peak, right? So the amount of money that we can potentially make might be, it's actually the same, right? Because these are limited risk, unlimited profit strategies, right? Because we're only limited in terms of risk to how much premium we pay for these options. But again, it looks a little different because of the fact that we're not buying the same strike and we're buying these outside wings, right? So me personally, I like to trade the Long Strangle for earnings, right? Where me personally, I try to target, if I was actually going to do a trade coming into earnings, I usually like to stick around this 30 delta level, right? So buying the 30 delta here, and again, buying the 30 delta above, right? So buying that put 30 delta, buying the call 30 delta, right? We have that defined risk trade where here is our risk, right? On a one lot, our max loss here is $4,612. And again, when we look at this zoomed out, obviously to the downside, we're capped, right? Because we would only make money on that put if Amazon went to zero, which is highly unlikely. And then again, we have unlimited profit potential to the upside because Amazon could again, rally. But again, remember, we're trying to put the probabilities in our favor. Again, a lot of the time when you don't quite know what's going to happen, maybe around earnings or whatever the catalyst might be for you feeling like you don't know what's going to happen, but you still maybe want to have a trade on to potentially profit. Again, remember, the purple line is our time value and the blue line is our intrinsic value at expiration. So maybe you put this on 30 days out in time and you bought this strangle, and as you're approaching the earnings event, maybe this thing starts to move quickly in one direction and boom, you're right into the profit. Look, you can see that here, down here, it shows us, right? Here's our date today and here's the expiration date, right? And we can see that if it made this large move over here, we would then be in profit and we could close this trade out for some profit. Okay, so again, the short straddle, the short strangle, the long straddle, the long strangle. Conceptually, right, when we're buying the straddle and we're buying the strangle, these are limited risk, right? We're targeting moves directionally either way that are significant moves. We don't quite know how much it's going to be, right? We could also make money from an increase in volatility here. And then again, on the short side, when you're selling the straddle, you're selling the strangle, you do not want that asset to move. You want it to stay in between your options so that you'll make money as time erodes away. Okay, so again, one more time, here is the long strangle, right? Here is the long straddle. And then again, here is the short strangle. And this would be the short straddle. Okay, so if you have any questions on these, feel free to reach out. Again, I'm so thrilled you're here working through these different ideas and these different strategies, because remember, it's a lot of information, right? Not only do you gotta understand the buy and the sell, the calls and the puts, and all of the different definitions and things that make up these option contracts, but we then have to understand how they go together, right? These strategies and how we can actually put these together so that we can profit from different scenarios that arise in the market. Okay, so again, I will see you in the next video.